market is about to throw off its sleepy blanket, and it's been a while since we have seen this kind of excitement. Hey there, I'm Jun, a researcher from Dxpert. Now buckle up because we are about to dive into what's coming next. Let's go. Over the past year, currencies have been stagnant, with central banks constantly waiting for more data before making moves. Most major currencies have been moving sideways except for the yen, which often dominates the headlines. With policymakers in wait-and-see mode, the market is in a bit of holding pattern. This is evident in the gradually declining average true range. However, as the saying goes, what goes down must come up, and vice versa. So today, let's delve into where trends might bounce back and get ready for when they do. After all, the trend is your friend, right? So, what exactly are central banks holding out for? They are waiting for a consistent drop in inflation. However, this decline seems to have hit a roadblock lately. As depicted in the first chart, the CPI, or Consumer Price Index, plummeted but has since leveled off, hovering close to Federal Reserve mandates but not quite hitting the mark yet. Additionally, both the Purchasing Managers Index, or PMI, and the Non-Manufacturing Index, NMI, are gradually creeping back up. Over the past 12 months, there's been a comforting narrative of the economy's supply side expanding, with pandemic-related bottlenecks easing and a surge in immigration labor force participation, enabling economic growth while inflationary pressures eased. However, while this narrative held true for many sectors, one notable exception was the US housing market. Take a closer look at CPI. Shelter constitutes the largest component, one that draws particular attention even from Jerome Powell. The US housing market has become increasingly congested, reflecting excessive demand and inadequate supply unlike any other sectors in the economy. Home builders are unwilling to borrow at soaring interest rates. On the demand side, factors like robust job growth and immigration have contributed. The numbers of people seeking housing is notably high compared to previous Fed tightening periods, during which rising unemployment typically dampened housing demand. One reassuring observation is that while housing prices are rising, it may largely be attributed to a base effect when compared to earlier data. The current figures are in line with or akin to pre-pandemic levels, where the housing price index typically hovered around 4 to 5%. Rent often serves as a leading indicator for the housing market, reacting first in the real estate cycle. Analyzing rent CPI reveals a consistent decline, with new tenant rent index even dipping below levels seen during the pandemic era. This suggests there's still potential for the CPI to gradually decrease, creating a scenario where housing prices play catch-up. Economists are surprised by the fact that housing inflation hasn't dropped more, given that increases in new tenant rents have plunged from 12% in early 2022 to just 0.4% by the first quarter. By all indications, this should be influencing owner's equivalent rent, or OER, and tenant's rent. But it hasn't happened in the manner or timing many of us anticipated, remarked Jonathan Pingo, an economist at UBS. Powell has been anticipating a significant decline in OER since late 2022, conceding the timeframe are considerably longer than we initially thought, as indications point towards a potential alignment of CPI with a decline in housing prices. Another indicator suggesting a recession rather than stagflation is emerging. The SAM rule now highlights signals associated with the onset of a recession, where the 3-month moving average of the national unemployment rate rises by 0.5 percentage points or more compared to its low over the previous 12 months. If the upward trend in the SAM rule persists, and we extrapolate this pattern, we might anticipate the 0.5% threshold being breached between November 2024 and June 2025. That's not too far from our current position, with the indicator showing 0.37. If the Fed maintains higher rates for an extended period and continues to delay rate cuts, the likelihood of these trends persisting becomes quite significant. However, central banks might act before this threshold is breached. This brings us to the topic at hand today. Central banks globally may soon begin adjusting interest rates. The differing timing of rate changes by individual central banks will offer us opportunities to capitalize on these new trends. In the next episode, I'll dive more in depth into potential decisions by individual central banks, so make sure to stay tuned. Thank you for joining me today. I hope you have gained insights from today's video. Everything I've shared are information that I've picked up and learned, sprinkled with a bit of my own takes on things. When it comes to trading and investing, do your own due diligence and be mindful of the risk. If you find this video helpful for your research, please subscribe, share, and like it. Quickly access to all our channels by scanning the QR code. Take care, and I'll see you in the next episode.